Here we are again.
Hello, how are you?
I'm good. How are you doing?
Doing better. You know, my bathtub is no longer leaking out onto my porch. I had a wonderful contractor come and fix it up for me yesterday.
So it wasn't like $1,000 had to rip the whole front off?
So, well, eventually we really need to pull up the tub and redo all the piping in my house that was built in 1949. But for now, we have a little patch on it and it's going to be great. And I have some future remodel decisions to make. I'll talk to my financial advisor.
Thank goodness you talked to yourself. Thank goodness
Real
that for good contractors, right? They know what they're doing professionally.
Yes. Yeah, I have a good recommendation if anyone needs one.
Yeah.
So.
And it's also today's the first day of the Olympics.
Yes, so exciting. What is your favorite Olympic sport? In winter.
In winter, okay.
Yeah.
So Winter Olympics, it is anything that has to do with downhill skiing and also snowboarding.
Yeah.
But what's yours?
Yeah. Oh, I really like the ice skating. Of
course.
Like,
I forgot about that.
My sister and I, as kids, we'd watch it, and then we'd put on our roller skates and go outside and pretend to ice dance.
I take it all back. Ice skating for sure is the best one.
It's so fun.
And it's so fraught. You get the Russians against the Americans and everything.
Totally.
Going on. It's
I love it.
But I gotta tell you, my worst sport is curling. I do not get curling, but the guys they're scrubbing the thing with their little brooms and everything. What is the point?
It kind of reminds me of shuffleboard, which I like.
Guess, but I just don't get it. Why put so much energy into it? It's a stupid thing.
I like the snowboarding, like the half pipe. I mean, I have tried snowboarding. I understand the skill level that takes, and I have so much respect for those athletes.
Absolutely, for sure.
Oh man.
Well, anyway, welcome to A Place of Possibility. I'm Richard Del Monte.
And I'm Angela Wright.
What are we talking about today, boss?
Here. Yeah, so, if you've looked at the stock market at all today or this
I hadn't noticed.
The markets have really been in a steep downward trend for most of January, and that's caused some investors to become concerned. So today we're going to talk to you about what to do when the markets decline now and in the future, and be able to decide what actions you should take or not take, like what's necessary on your part to respond.
Good point. Everything we're going to share with you today really assumes that you have a well-diversified portfolio to start with, okay? And that means you have the right mix of, you got large stocks, small stocks in the U.S. and also in the same kind of thing in developed markets and also in the emerging markets.
Yeah.
And some real estate, things like that.
And hold on, if everything he just said is totally Greek to you, go find our episode 10 when it's about selecting the right investments for you.
Good call. And you also have the right amount of bonds and fixed income, like cash and money markets and things like that, so that you don't have too much risk overall in your portfolio. That's a big one.
Yeah.
Okay.
And we're also not talking to folks who are really concentrated in one or a few stock positions. This is particularly important if you're in highly speculative companies that don't have a lot of earnings to support the stock prices. I.e. like today, if you're invested in Facebook, you're probably hurting. If you haven't looked at that yet, maybe don't.
One day.
And so if you're in this situation, get some help from a professional. And we're also, specifically not talking about things like crypto investing that really doesn't come into play with the historical data that we have. So we're not speaking on that today.
Right.
And this doesn't really apply to you. So this is for our investors that already have a diversified portfolio.
Right.
So what's first?
Okay. So first, it's important to understand that market declines are absolutely 100% red-blooded normal things to happen.
Yeah.
They are not things to be like sitting with white knuckles and gripping in terror. They're just the normal part of investing. In other words, like the policeman saying, "Nothing to see here, folks. Just move along," because it's really not that big of a deal. But it does feel that way. But they do occur with a lot of regularity. So, for example, there are the 10% declines that happen, like we just had right now in the Dow and the S&P. They happen about once every couple of years. They're
1 to 2 years
regular.
usually.
20% drops happen every 3 to 4 years. Not even, but about on average every 3 to 4 years. Then there's the 35% declines, which that's what people really freak out about.
Yeah.
They start getting really worried, like this is the end of my world, it's cataclysmic. And those happen about every 7 years. So I've been doing this for 37 years now. They've happened 5 times in my career. So when people are terrified about this market crash or some guy predicting, this biggest bear market, those things are so rare that they just don't happen that much. And then you have the 50% declines, which they don't really ever go below 50, honestly, in the modern era.
Yeah.
And so those have happened 4 times in the last 100 years. 1929 to the early 30s, 1973, 74 when the oil embargo happened, the Arab oil embargo, 2000, 2001 during the dot-com crash, and then the housing bust in 2008, 2009.
Yeah.
2007 to 2009.
Yeah.
So they're not that frequent, so when we worry about those things,
yeah, we're worrying about things that happen kind of rarely.
yeah,
actually.
extremely rare.
Yeah.
They're like the so-called black swan, right?
Right.
Yeah, they're just not, they're not worth worrying about.
Yeah, they're worth planning for because we're aware that they happen,
Right.
and we need to make good choices in advance. But I think the thing that really gets most investors is the media around these market declines, right? Like, and we're not anti-media. News is great, but the financial media makes money by sensationalizing this. Their job is to freak you out so that you won't turn off the TV and you'll watch all the commercials. And they really perpetuate fear, and they often make it more than it is. I mean, I got a notification on my phone a couple weeks ago, and it was a guy, it was a market trader on the floor, and he's like looking all distressed, and it's like stocks on pace for the worst January in history. It's like, that's so dramatic and unnecessary to send me a notification on my phone saying that. And I really can't underestimate enough how much the media impacts our emotions when it comes to investing. And by and large, you can ignore most of it. It's noise, right? Like, get the headline, understand what's going on. Why is the NASDAQ in decline today? Well, Facebook earnings came out. Investors didn't like it. They're dragging the NASDAQ down. Yep. That's all you need to know. Move on from there.
Yep. Facebook will be fine in a year or two, whatever, there's been 2 crashes before. It's funny about the watching, like, these financial news channels, I won't call any out, but if you're watching the markets drop and it's a big precipitous drop, I am trained really well to not be affected by them. I feel the thing in the pit of my stomach too, like, oh, this is really bad.
No, totally.
But they're not going to get on there and say, hey, don't worry about it, everything's fine. It'll all be fine. They were not, because no one would watch them.
Right. If it doesn't bleed, it doesn't lead.
There you go. Yeah.
That's it.
Because I like that. Yeah.
Yeah.
I hate it, but I like it. Yeah.
Let's put the declines into perspective for you. So we're going to be showing some charts for those of us who are watching this. And if you're not watching, you can get the charts from the show notes. So let's take a look at the first chart. You want to walk them through it?
Yep. So this is a slide of the stock market going back to 1926. Through 2020, and it's a sideways view. It's like if you got one of those slides like in biology, and you cut a little slice of it, and you were looking at it sideways. And what you can see there is on the bottom part on the horizontal line, you'll see all the periods. I think they're in red, right? And they show the market declines of 20% or more. And there have been 17 of them since 1926, which seems like a lot, right? And you think, well, if there's 17 times and it lost 20% in 100 years, have we made any money at all? Well, glad you asked, because the reason is the subsequent bull markets that happened after those bear markets were up 500, 800, 900%, many times, just straight up. And so those things overcome, they recover and way more the temporary losses that you get. So if you look at that graph, if you're listening to the podcast, get the notes and look at it, because it's a powerful image
when you look at the proportion of down markets to up markets. And we spend so much time being fearful of these down markets and energy and money, frankly, right? Being afraid of these down markets. But the reality of our situation is we spend most of our time in the blue here. Yeah. Most of our time.
And it's like saying, I don't want to live in California because it rains once in a while. It's like it's ridiculous. These downturns, I hate to make it sound, make them like they're no big deal, but they're like getting mosquito bites.
They are.
Compared to what, the benefits. They're just not that big of a deal.
In a well-diversified portfolio.
Right.
And I think we can we're going to touch on when it is a big deal a little bit later.
For sure. Yeah.
And so I think you might be looking at this chart saying, okay, well, why don't I just get out right before the red and then get back in right before the blue? Genius strategy. Why would I even bother riding that wave down? Hello.
The answer is because nobody's ever been able to do that. No one's ever been
Correct.
able to consistently time the market. You always get these one guy. He called the 1987 crash, and then he was wrong for the next 20 years,
Yeah.
and people stopped listening to him. Finally,
Yeah.
But you can, a stopped clock is right twice a day, right? I mean, so you just it's not possible to know when the next big market crash is going to be.
Yeah, and what most people do is they wait for it to recover, right? They wait for some green, and they're thinking, okay,
Yep.
yeah, all right, wait for some green. But really interestingly, some of the best days in the market happen right after a big decline. It's usually in that first week we see huge returns, and most people wait until after that. Well, guess what? You're too late.
Right.
If you wait until that point.
Right.
And in fact, if you had missed, what is it? The best 25
days
over the last, what's the time period?
Since 1990, so that's like 30 years.
Okay, so if you had $1,000 in the market in 1990 and you just left it there in the S&P, today you would have $20,000.
Yeah.
That's pretty good.
Right.
However, if you had missed the best 25 days, you would only have $4,300.
So you lose 75% of the benefit
Yes.
by being out of 25 days out of the market in 30 years?
Yes.
Okay.
And how easy is it to miss those days? Because if you got out in that decline, you're not going to get back in until after one of those days. I guarantee it.
This is one of those checkmate moments, folks. Checkmate. You're dumb if you get out. Try to time the market.
Yeah,
because you miss out.
yeah.
You're mistaken. Sorry, you're not dumb.
No one's dumb,
No,
right?
but it's just you don't know. It's a lack of understanding of what they knew,
Exactly.
which we're trying to help them know.
Right.
They wouldn't bother with it.
Yeah.
Right.
And it's really hard
Yeah.
when you, and especially when you live in the United States and money and status is everything to most people,
Yep.
like watching
Yep.
your portfolio decline triggers huge emotions. And I get that. I really do. It's super hard to watch
Yep.
this happen.
Yep.
And we're not minimizing that, the emotional impact of this, but we do have some tips to help you deal with it
Yep,
because
yep,
you have to.
Yeah. One thing that, for those of you that know me, you've heard me say this a bunch of different times. When I first got into the business, when I got my fresh new MBA and I was all polished and going out, going to slay the world, the Dow Jones Industrial Average was at 1,500, which I know dates me. I get it. You'll find out it happens to you. It'll happen to you too. But
It's like the dawn of time, 1500.
I know, man. It was like it was rickshaws and everything, and we were riding dinosaurs to school, all that. But and people were running around with their hair on fire saying, the market's too high, it's too high. And I'd go to these cocktail parties and they would say that. I'm like, oh, well, how do you know it's too high?
Yeah, wasn't there even a book, Irrational Exuberance, written at that time?
was Alan Greenspan, like in the 80s, yeah. And so in the meantime, the markets have gone up to now, it's at 36,000 or 35,000, was up to 37 recently. And so in between 1,500 and 37,000, there's been bunch of different crashes, many crashes.
You just described five
or
crashes
six.
of 35%
Five, at least
or more.
35%ers, and plus a bunch of other ones, and two 50%ers, and we're still at 36,000. And in fact, if you look at the dividends reinvested, the S&P 500 is up about 50-fold in my career alone.
Yeah.
So what am I supposed to be worried about? Please help me understand. I do not get what I'm supposed to be worried about. Why I can't just put the money in there and just like, oh, it's down again, whatever.
Yeah.
Honestly, that's the only way you're going to make it make sense. If you could be Rip Van Winkle and put the money in 20 years ago and let it ride, you would or 30 years ago, you would have 20-fold increase.
Right. I mean, even think let's take it more recent so that people can recall how they actually felt during this time. So like you have the .com burst in 2000,
Good
you
call.
have 0809, you have the housing crisis, which became the Great Recession. You have even a 35% drop for COVID in March of 2020.
Mm-hmm.
So reflect for a moment. How were you feeling at that time? Probably terrified. I was, certainly, even with my knowledge. What actions did you take? Did you put more money into the market? Did you hold? Did you pull out? What was the benefit of what you did? And what hindsight do you have today? Because the next crash is basically going to be the same as the last one, right? It went down, it's going to go back up. It's not different this time, which the news media would have you think otherwise. But what do you wish you had done, right? In 2008, I wish I had taken all the money I had in fixed income and threw it into stocks.
Oh.
Had I known what was going to happen next, I would have done that. Right? Instead, I kept my allocation and all is still well, but what would you do differently? So the next time you see a big market crash happening, like, we're in a bit of a decline right now. Think, okay, March of 2020. I mean, that was over in a flash. And okay, what choices am I going to make this time?
And it was huge at the time, but in hindsight, it's like, oh yeah, I kind of remember that. It's just not that big of a deal. In fact, in one of the crashes, in the one for the 0809 one, my mother called me up because what we do for our clients is we buy a little bit more stock when the markets are down to try to true it back up. If it went down 30%, we're going to buy some more and get it back to where it should have been in the percentage wise. So I did that for my mother, her account. And she called me up and said, what are you doing buying stock? Don't you know the world's coming to an end? This is the end of the world. What are you doing? I'm calling the police on you.
The police.
And I said, Mom, how could you're going to call the police on me? That's just incredible, And so, but the emotion is really difficult to deal with for folks.
Yeah, and we have another chart to show you. So if you're not watching, grab this one. Markets have rewarded discipline, and this shows you all of the really scary news stories that have happened since 1970. And I mean, think about it. Does anyone remember the fiscal cliff? Remember when we weren't going to be able to make our debt payments and China was going to take us over? And oh my gosh, that was such a terrifying
thing. It was huge.
It was the end of the world.
Yeah, the whole month of August was terrible.
Oh my gosh. Yeah. And some of these are like such blips on my radar that earlier we were talking about
Eurozone.
The Eurozone.
Remember when Greece was going to go broke and Spain and all that?
He goes, remember that? And I go,
it was horrible.
I go, no. Actually, I don't really remember that because it was in the grand scheme of investing. That moment was so insignificant to my overall portfolio that I've now let it leave my mind. Who cares?
Yeah, it was 2010 to 2012.
Yeah.
Massive concern among everybody. They're going to drag us all down.
Yeah. I mean, it was really, looking at this chart, the next time you see a big news story, I want you to come back and remember this chart and remember all the times you thought the world was going to end and then say, right, it didn't end. This is just like last time. It's another blip on the radar. What can I do? Which we'll talk about in a second, what you actually can do.
Yep, it's true. It's not different this time. That's the biggest thing. Everybody, it's different this time. No.
Not really.
It is not, for sure.
Yeah.
All right. So you're going to do the presidents?
Yeah. So another thing that people get really afraid of is the political climate here in the United States. And, specifically lately, people are talking about this a lot. You really didn't hear about it,
politics.
Until more recently. But people were really freaked out about this and instability in the government. And there's this assumption that, the political climate and the markets are tied to the hip or joined at the hip, excuse me. Frankly, the notion that the president controls the stock market is laughable. Yeah. And, the presidents don't control the markets as much as some of those egomaniacs would like to think they do. And I'm talking about all of them because that's like a requirement of the job. But, they really don't. And even if you look at who held Congress during different presidencies, there is no correlation to the stock market returns and who the president was or who was in Congress during that time.
Yep.
So the next chart you should be seeing on your screen here, is Congress and the market returns. And
I mean, you could flip those parties, make the red part blue and blue red, and it would be the same. I mean, the return you cannot find any correlation between market performance and who runs the government.
Yeah, I mean, I suppose you have some short-term influence of what's going on in the legislature. Obviously, if taxes are going up, the markets don't like that. They will temporarily dip. Yep. But you could look at the chart. There is no correlation between the markets and politics. Yep. And, also for those of us who are worried about the United States going socialist and all that, Scandinavian stock markets exist. And in fact, I looked up the Oslo exchange is up 71% over the last 5 years to our 91%, slightly less, but, I didn't filter for anything.
But socialism doesn't kill the economy.
No.
For sure. Yeah.
No.
Which brings us to another point. And that is on that same note, capitalism is like a weed that grows and there is no Roundup that can kill it. It's kind of like COVID, actually, right? Keeps coming back no matter what. It keeps beating it down. It comes up in other places like whack-a-mole.
That's really good.
I mean, yeah.
Capitalism whack-a-mole.
You cannot kill capitalism no matter what. And so my best example to demonstrate that to you is the Soviet Union in the 1980s. Mm-hmm. So basically, those of you that are old enough to remember, people couldn't. They would get they have milk at the store. Everybody go get in line at 2, 3 in the morning and get a gallon of milk or shoes or whatever. But if you wanted to get good, the good stuff, you could always get it on the black market. You had to pay a big price, but you could always get, great vodka or whatever you wanted to get, Jordache jeans and stuff like that. So that the black market is nothing but pure unfettered capitalism.
Yep.
So capitalism will make things happen. And if you look at what our companies and our people have been able to do over the last 2 years through COVID. I mean, just imagine it'd be if I told you 2 years ago, we're going to go through this thing where everybody's going to have to stay home. The entire work world is going to change. There's not going to be any more offices for many, many years. But yet the economy is going to be better than ever. You'd be like, you're tripping.
Yeah, well,
no way, right?
No, the way the markets responded when we shut down indicated that we thought, the economy was going to take a huge nosedive.
Right, and it did initially. But they came back. The point is they were so adaptive and resilient that they figured out how to take the conditions that they've been given, these companies, and make money and beat the old limits of what they made before.
Yeah, many of them are more profitable.
Right.
Yeah.
And more profits is what really drives the stock market, not Joe Biden, what he's doing, or Donald Trump, or the Congress, or any of that stuff.
Yeah.
They're tinkering with the edges, but
and even the people, right? Like people found that their jobs were gone in retail, or they don't like the pay that corporations are offering today. There's been a little bit of a mindset shift. And so what did they do? They went out and got gigs. They became consultants. They entertain people on TikTok and Twitch and other websites we won't mention here. And they have found a way to make money and keep capitalism going, even though there weren't jobs for them or jobs that they wanted.
Yep. And the next time, I'm sorry.
Go. Yeah. No.
The next time you want to worry about, like the effect of whatever's going on the economy, think about whether that's going to stop people from going out and buying new cars, buying televisions, computers, refrigerators, all those different things, getting medical care, getting their prescriptions, diapers for their babies, furniture. It's not going to stop all that. No. That's going to keep on happening.
The only real danger to the stock market that I'm considering now is minimalism.
That's true. That could be, but someone will find a way to market to those guys too.
Yeah, you need all the containers.
Yeah, I'm gonna let you pay 4 times as much for 1/5, and we're gonna make a fortune. Right?
Yeah.
Yeah.
So, we talked a lot about how, we can't time the markets. We diversify our portfolios. You've done all the stuff, but you still have to weather the storm.
Right.
How do we deal with this? And many investors follow their emotions. So we have a little chart here, and imagine that this is the life of a stock, right? Going up and down. And so we start really optimistic, right? I mean, think of how we were kind of at the end of last year. 2021 is coming to an end. The stock markets are at all-time highs. Yes, we were elated. And then, boom, January hits, the market goes down, and suddenly we're all really nervous. Clients are starting to call us fearful, right? And we're now down in that valley of fear. And isn't it funny how, just some numbers on a page can trigger our emotions like this? And many investors, unfortunately, will act on these emotions. They will sell at the fear point, and they will buy at the elation point, which is the exact opposite of how you make money in the stock market.
Doesn't sound like it would work very well.
No, it doesn't. And the average investor does this. If you look at the difference between the S&P, if you set it and forget it, versus somebody who's tinkering on their portfolio, on average, they're earning, I think it's 2.5% less than the S&P for those who are actively trying to outpace it. Yeah. And it's because they make the wrong choice way too many times.
Based on emotion.
Yeah. Emotions really are the kiss of death for investors. They have no role in investment management whatsoever. Right. And so we have some ideas for you to help you kind of rein in the emotions and what to do when you're feeling
Let me add one thing. Yeah. It's a little bit self-serving to say this, but that's why it really helps to have an intermediary between you and your money. Because if you have an advisor, we're not emotional about the stock market. We just go in and say, okay, we know what to do. We're like, you have to be cunning. When everybody's running for the hills, you want to be greedy. Yeah. Right? So, anyway.
Yeah.
Okay.
What's our first topic?
All right. So our first topic is, our first piece of advice is turn off the financial news channels.
In case you didn't get that yet.
They are, those channels are investment pornography. I'm sorry.
It's an insult to pornography.
They appeal to the prurient interests of you, and they don't do anything to add to your long-term returns. In fact, I really think there should be like a class action suit where the whole nation sues those financial media companies because they've cost you hundreds of trillions of dollars. Maybe not hundreds of trillions of dollars
maybe.
of lost money because you got out because of you're watching these idiots get on there and spout their nonsense.
Yeah.
So just turn that off. They prey on your fears and they're just trying to terrorize you and not reassure you.
Totally.
Yeah.
So the second thing that you can do is change your relationship with down markets. So instead of seeing this as something to be endured and something that's really terrible, instead see it as a sale, right? We all get really excited on Black Friday and we rush out into the stores to buy these things that have been terribly marked down.
Trampling each other.
Otherwise, like to see a sale like that in the store on not when you're not expecting it, you would think there's something wrong with the product and you'd run away from it, right? But for when we're expecting the sale, we're like, oh yay, a sale! Let me go buy all this great stuff. Think about the markets in the same way. Oh yay, a sale! What cash do I have hanging out on the sidelines that I could reallocate to take advantage of that sale? So you could start to see it as a good thing.
Yep.
Get really greedy when everyone else is running for the hills, and be really cautious when everyone's piling into something.
Yep. And use your emotions as a contra indicator of what you should do.
Yeah.
Like you want to run for the hills, that means go in and buy more.
Do the opposite. That's actually pretty good. Do the opposite of what you think
opposite
you
of what
should
your
do.
limbic brain wants you to do, and you'll be really successful.
Yeah. And also remember that your neighbor and your brother-in-law are full of bull. When they're talking to you about their returns, that's probably true, but what they're leaving out is all the bad choices they made and all the stocks that they own that are currently down. I promise you, they are cherry picking and only telling you about the good in their portfolio and not the bad. Like, I know these people.
Right.
They are not telling you the whole truth.
Yeah.
So please be cautious. Like I find a lot of our clients will try to chase that. And then what you're doing is you're chasing something that's already up.
Yep. So in other words, consider the source. Okay, another thing to do is to imagine your investments and the stock market in general as a yo-yo going up the stairs. So imagine a person climbing up the stairs and running a yo-yo up and down as they're doing that. Yes, the market will go down, but when it comes back up, the person has stepped a couple more steps up, and the next time it goes down, the low is going to be higher than the last low. So it just kind of zigzags and goes up the stairs, and that's a really good analogy. Again, it's just normal.
I love the visual of that one too.
That's what happens. That's how it works.
Another thing that you can do is ensure that you're set up properly to begin with the way that you allocate and diversify your portfolio. Make sure, most especially, that it matches your own risk tolerance and goals. So, there are best practices in diversification, but if you're trying to buy a house next year, your money does not belong in the volatile stock market.
Or crypto.
Yeah, right? Like, match the investment to the goal and the time that you have in the market. And again, if you don't know what we're talking about, episode 10, we really get into allocation and how to choose the right investments for you.
Yeah. And another thing, it's not on our list, but don't confuse investing with gambling or speculation.
Mm-hmm.
They are two different things.
Yeah.
Yeah.
Both cool,
Yeah.
worthy.
Yeah.
Go ahead and do it if you have
Yeah.
the money to lose
Right.
on speculating or gambling.
Yeah.
But there is a difference.
Yeah, for sure. Okay, the next tip is to change the subject when everybody's talking about the markets, or you're really worried about it, waking up in the middle of the night and you're kind of you're having that stomach churn. Just don't even think about it. I
Don't think about an elephant.
Again,
Don't think about elephants.
Yeah, right. Don't think about that.
No, you have to replace it.
Right. Go shopping. Go play golf. Go see your grandkids or your children, or take your kids to the zoo. Don't look at your statements when the markets are down. Like the January ones just came out.
Ignore
Don't look at it. It's not all it's gonna. What's it gonna add to your process other than to make you fearful and less willing to? We have people that are putting in the money. Market goes down. They're putting in money every month, and they're like 30 years old into their 401k. They want to stop putting the money in the stock market when it's lower. They've paused those things.
I've had that question.
And no, you want to put in, if anything, put in more in the market.
Pre-fund your 401k right now.
Yeah, for sure.
Yeah. And you can also recall your goals on that point. So another thing you can put in your mind other than the fear is the goal. Why am I investing? What is the point of this? How many years do I have to achieve my goal? When I see my 401k drop 30%, I think, okay, well, my kids are babies. I still have at least 25 years before I'm even thinking about retirement. Okay, no worries.
Yep.
And for those that are already retired, how many years of your income do you have sitting in fixed investments like bonds or cash for like many of our clients, that's like 6 years worth.
Or some have 18. If they're more conservative, like you might have enough in there for many, long time.
Many years.
Well, hey, Joe, does that give you enough time for the market to come back? You think it'll come back in 10 years? Yeah, sure it will. Okay, then you're fine.
Yeah.
You're not going to go, we're not going to sell your stocks when they're down. Right?
Yeah, of course not.
Yeah. So that's a good reframe as well. Yeah. Okay. If you, you have to do if your main, let's see. Oh, yeah, this is mine. Sorry.
That's okay. We're live.
We'll get back our little assignments. Okay. So if you're still, after all this we've been telling you, all the points we've been trying to make with you, if you're still unconvinced that we're going to be okay after this downturn, consider these stats, which are just came off the press yesterday. 76% of companies that reported earnings this quarter beat their expectations. In other words, the analyst said they're going to report this much money, and 3/4 of them beat that number. Jeez. That's a big number. Profits are up 18% from a year ago, and they're expected to increase another 33% in the next 12 months.
During a global pandemic. I'll just remind you, that is still very much happening.
So does that sound like a market route, the makings of a good market route when you have those kinds of underlying things? Yes, we have inflation. Yes, Ukraine might get invaded. Yes, there's always these little things. But again, Ukraine getting invaded is not going to change whether you go out and go on vacation or not, more than likely, or buy Ukraine, diapers or whatever, right? So
yeah. And so, okay. So we've showed how market declines are normal.
Right.
And to be expected.
The media
is your enemy, not your friend when it comes to financial press. Politics have no bearing on financial returns in the long term.
Right. Market volatility is normal.
Yes.
And I think I just said that. And the markets go up way more than they go down.
Yes.
Right?
Yeah.
Yeah.
Good recap.
Yeah. And try to change the subject so you can deal with your emotions. Your emotions are the biggest deal killer or wealth killer that you can even imagine.
Yeah.
Right.
Absolutely.
Okay.
Let's see if we have any questions. I'm sure we do. We covered a lot today.
Okay, well, we have one. What do I do if I didn't diversify and now I've lost a lot of money in stocks?
Do you own Facebook today? Just kidding. I'm just kidding. I'm ragging on Facebook. Here we are live on Facebook.
Yeah. I mean, a lot of it, I would say, we can just kind of...
Yeah, go for it.
A lot of this, I would say, would be dependent on what you have in there, what you have. And so if you have like all Facebook, I think probably waiting it out would be the good way to go. And then diversify.
Yeah.
Don't be in this situation ever again.
Yeah.
We have a lot of people that are really heavy in tech stocks. They've gotten their head handed to them. And some of them are, the wise ones are like, I'm rethinking my strategy because I don't want to be in this situation ever again. So that's smart, because it's hard to be able to look at what you're doing realistically and admit if it's not working.
Yeah.
But I think if you are way over concentrated in 1 or 2 or 5 stocks, you might have to just bite the bullet and diversify because we don't know. I mean, who knows? It could go down more potentially, especially because some of these tech stocks they're selling at 1,000 times earnings. Whereas Apple might be selling at 20 times earnings. Well,
this is very reminiscent of the late 90s,
isn't it? Absolutely. Yeah. There's nothing supporting these high valuations. And even if a stock goes down 50%, it doesn't mean that's all it's going to go down if there's no earnings to support it.
Yeah.
So if Apple goes down 50%, then it's only selling at 10 times earnings. That is a cheap stock by any historical standards. So you've got a lot supporting Apple. You don't have anything supporting something like Tesla, for example. And I'm not a bear on Tesla or anything like that, but I'm just saying it doesn't have the support levels that you have to look at the earnings.
We've said bear and bull a lot in this podcast, but I'm not sure that everybody really understands what that means. Like the news says that we're in a bear market. What does that mean?
A bear market is usually a decline in the stock market of 20% or more.
And a bull market?
A bull market is anytime you go past the 20%.
There you go.
Yeah. And if it's a correction, in other words, a correction is defined as 10% down, you're still in a bull market technically if you have a correction. That's not leaving the bull.
I think it's a good thing to define because people hear bear market and they get really scared, but it just means the stocks have gone down 20%, which as we've shown you in these charts and verbally today, that happens. It's frequent to be expected and it's nothing to be afraid of. Are there more questions in there?
Anything more? Okay.
No, okay.
Well, we hope that this was valuable for you. We expect that you could make some serious money by just maybe changing the way you relate to down markets and the way you think about them and the people you talk to about them and the advice you seek from people. and your brother-in-law doesn't know everything.
Agreed. And if you're watching a chart right now, because I understand the markets are down pretty significantly today, turn off your computer and please go take a walk. It's a beautiful day, and I promise you it'll make you feel better.
It'll make you feel
Really
a lot
will.
better.
Yeah.
So in the meantime, we have our book. We still have our book that we offer, which is Endless Inheritance, which copy right here, that we wrote. And it's about how to make sure that your family doesn't waste the money that you have spent your lifetime creating when they inherit it. And that's available for free if you just send us an email to info@aplaceofpossibility.com. We also offer half-hour free consultations, but you can go to the same place. You can go to our website and set up an appointment right there using Calendly. And what else? What's
So
the other
fancy.
thing? What else? Yeah, there's a third thing we always talk about.
We'll be back in 2 weeks
Oh,
with
yeah, 2
another
weeks.
awesome episode. So we lied to you last time, and we
Yeah.
told you that we were going to continue the conversation about talking to your partner about money, and we were going to dig into actually the agenda and how to have that conversation. But we really needed to talk about the markets today.
Yeah, right.
So we'll be back in 2 weeks with some real live how to have this money conversation with your partner.
You don't
Should
want to
be a
miss
really
that.
good episode.
You don't want to miss that.
Yeah.
Okay. Well, thank you very much for watching and listening. And remember, you're invested, and so are we. Take care, everybody.
Bye.